Hi folks, welcome back to part B of our problem, Red and Saks, where Red is the parent, Saks is the sub. In this example in part B, it's similar in that we're still affecting the business combination through a purchase of shares. So Red is buying the shares of Saks's shareholders in order to control Saks. But the only difference here is that instead of Red giving up cash to buy the shares from Saks's shareholders, it's going to give Saks's shareholders some shares in Red as compensation or consideration. Okay? So when the investment is happening, we're going to debit the investment in Saks for the value of the investment. But notice, different than Part A, here we're going to be crediting common shares. And the common shares that we're crediting are 960,000. So these are the shares, Red's shares, that they are going to issue to the shareholders of Saks. And in return, the shareholders of Saks are going to give Red their shares in Saks, right? So again, we're crediting the common shares, and these are the common shares of Red. So Red's making this journal entry in order to get controlling interest of Saks. So now the question also says that as part of this business combination transaction, there were also legal fees associated with issuing the shares, and that was $6,000. Now remember, when we were discussing the concept of acquisition cost, we said any fees incurred for issuing shares, we would use the offset method and debit common shares. All right, so in this case, there's another cost that Red has. Red has to debit common shares, also incur the professional fees expense, which is to draw up the deal. We saw that in Part A. But they're also going to have to credit cash in order to pay the lawyer who issued, or the legal fees associated with issuing the shares. Okay, these were these shares that Red issued to Saks's shareholders in exchange for getting Saks's shareholders shares in S. All right, so those fees that they had to pay were $6,000. But again, we're not going to debit an expense account because this is related to a share transaction. So we're going to debit an equity account, and we debit common shares directly. The professional fees, we saw that in Part A, that's $18,000, and they're going to have to pay out cash of $24,000. So now, in order in Part 2 of Part 2 in B, in order to do that balance sheet, we don't have to redo the calculation of goodwill. It's the same as it was in Part A, and we know that goodwill was $84,000, so we're not going to redo that. But we do, in this case, have to complete the consolidated balance sheet by noting a few things. First of all, using the direct method, which adds the carrying value of Red's items on its balance sheet, in this case, I'm looking at current assets, it's going to add to its carrying value of current assets the fair value, which is carrying value plus the fair value increment of Saks's current assets. But in this case, we have to remember there was not $978,000 paid out as there was in Part A, which we used to make the adjustment in the current asset account here when we did the consolidated balance sheet in Part A. In Part B, the only cash that was paid out were the legal fees associated with the share issue and the professional fees expense of $18,000. So we're going to deduct $24,000, not $978,000, as we did in Part A. We notice here that when we're looking at using the direct method to calculate the balance in the plant and equipment account at net, we're again going to take the carrying value of the plant and equipment assets of the parent Red and add to it the fair value, which is the carrying value plus the increment on the plant and equipment of Saks. Again, this is in line, this thinking fair value of the sub plus the carrying value of the parent This is in line with the acquisition method, which is the method of accounting for business combinations under IFRS 3. So when we add all these numbers in the brackets together, we get 2,052,000. Similarly with the patents, as we said in Part A, they're going to get set up at 72,000 and 84,000 for goodwill. This was the goodwill we calculated in Part A. So now you see your balance sheet is going to add up on the asset side, not to 3,298,000 as it did in Part A, but 4,252,000. That's the difference from the 978 up here. We don't have that here. So we're going to get a different number for current assets. So that's going to create a different number for total assets. Let's have a look at completing the balance sheet. So again, we've got current liabilities. Note here that the carrying value and the fair value of the current liabilities to Saks are the same. So we're just going to add in the fair value, which is also carrying value. And that's going to be giving us a total on the consolidated balance sheet for current liabilities of $1,612,000. Our long-term debt, again, the carrying value of the parent's long-term debt, plus the fair value of the sub's long-term debt, which is $384. But again, we're spotlighting or separating out the increment because later on in subsequent chapters, we're going to be amortizing these increments. It's $864. Notice here now in the common shares, that looks a little bit different than it did in Part A. Now we have the common shares, only the common shares of the parent Red, but don't forget to affect the business combination. What Red did is Red had to issue its own shares in this case, in this illustration. So that 960,000 has to be added in. So this was the common share value, dollar value, for all the shares that were issued by Red to its own shareholders. Now what they've done is the shareholders of Saks are also in this illustration. They are shareholders in Red now. So the additional shares that were issued to affect the business combination, as we saw here, these are the shares of Red that were issued to the shareholders of Saks in order to get their shares. So that 960, this amount here of 720 was the total dollar value of all the shares issued before the business combination by Red to its shareholders. The 960,000 represents the shares issued by Red to its new shareholder group, Saks' shareholders. And again, don't forget, using the offset method, because of the legal fees associated with issuing these common shares, we had to debit the common shares, so we have to follow that through. And again, minus 6,000 to get 1,674,000. Retained earnings on the consolidated balance sheet, again, would be the retained earnings only of the parent Red, but we deduct the 18,000 because we have to remember that by the time we're doing consolidated statements, our statements would have also been updated and we would have closed out the expense to retained earnings in the closing process. So that would give us 102. So again, we have a balance sheet consolidated that balances, but in this case it will balance to, unlike Part A, here it balances to 4,252,000. So this concludes our discussion of problem 3-7, or I should say of this problem, where we are looking at the purchase of shares to affect a business combination.